In this video, we're going to be talking about the CCX indicator. And what we have on the chart right now are three particular indicators. There are two ultimate divergence indicators and a CCX indicator. This other thing called bar number, you can just disregard that. There are two divergence indicators here. They're both set up identically. One is set to plot the pivots and the divergence on the ES itself, and the other is set up to plot the oscillator itself as well as the signals on the screen. Now you're not seeing it on the screen for a reason that I'll fix in just a moment. But let's go in here and let's discuss how do you get the divergence indicator to plot the oscillator as well as the signals on the screen. The first thing we want to do is set the thresholds. Now, we don't have to use thresholds, but we are for various good reasons. So you come over here and you set this to true. Use the threshold number 1, and threshold number 2. We've selected the upper threshold at 200, the lower at -200. Now what we want to do is get it to plot. So over here, we plot bearish oscillator. That means plot the CCX, because that is up here in these two fields. The formula for that is up here. So we want to plot the oscillator, and we want to plot the threshold, the upper threshold and the lower threshold. So all of this has to be set to true. The next thing you got to make sure you do is change the scaling. The default of the scaling is the same axis as the underlying data. That'll get things to plot on the ES, but we want this to plot on subgraph 2. And once we do that, we'll now be able to see the plot itself. Now, what we just unfortunately did is we laid it on top of our own indicator. Let's move that. There we go. Okay. So as these indicators are now plotting on the screen, they're using just a line for the sake of display rather than the histogram. But you can see that the pivots as well as the divergence are exactly the same, or in exactly the same place at the same time here and on subgraph 2. So all this is enabling you to do is to verify that the pivots are taking place where you want them to. And what we're talking about here is that we want to make sure that the pivots are taking place according to the rules. And the rules are the pivot has to take place when it breaches the threshold, the upper and the lower threshold. You've got a pivot here, it's above the threshold, above the threshold, above the threshold, above the threshold. Okay? Below the threshold, below the threshold, below the threshold, below the threshold. Now, there's various reasons why these particular pivots are selected. That's based upon the settings. But this verifies for us that the indicator is capturing our settings correctly. Now, let's go over to a particular point here. This is getting close to the open, and my open is at 7:30. Now you notice, and we'll spread this apart a little bit. Let's get that a little further apart. All right, so right before the open, we have 1, 2, 3, 4 pivots. Now, again, the definition of the pivot has to take place, the hook, in other words, has to take place after the indicator has breached the threshold, in this case, the lower threshold at -200. So now, if the spoos go lower and the indicator, the CCX indicator, has a higher value than it did at the time of the pivot, then we can get a divergent signal. So that's why we have these signals in here. And then based upon the settings, another pivot could show up. So the next divergence will plot if the spoos are lower than the price of the pivot and the indicator is higher. Here, you've got another pivot, but it's now actually at a higher price. So conceivably, you could get a divergence at a price that was higher than here. That didn't happen, but it could. Now you've got another pivot here. It's lower than the threshold, and the divergence indicator plots the cross when the value of the oscillator is greater than it was at the time of the pivot. Now let's go over here. We drop below the threshold at 200, we get our pivot, and this pivot is now higher than this. Now, as most of us look at the performance, the price action of the spoos, we wouldn't normally expect this market to go up here. We would be feeling much more comfortable if we drop below this low. And once we drop below that low, then we might consider taking a trade. And various other things that we could use for support and resistance might tell us that. So how can we manipulate the settings so that we don't have all this noise in here? There's several ways to do that. So let's look at the first one. You'll notice that there's a distance between the pivots. You can establish settings in the indicator as to how far apart the pivots have to be in order for them to be plotted. Now here, again, this is a 5-second chart. All right? This is 20:05. This is 22:40. So perhaps what we should think of doing is increasing the space between the pivots. Now, if we do that, it's going to change the results dramatically. And there's really no right or wrong to this, but using a 5-second chart, I would think that, well, let's see, there's 20 bars, 25-second, or pardon me, there are 12 5-second bars in 1 minute. Okay? So looking at the amount of time that I wanted to spread between the pivots, if I wanted let's say 4 minutes, hypothetically. 4 minutes, 4 times 12 is 48. If I wanted 4 minutes between the pivots, or 5 minutes between the pivots, 5 times 12 is 60. What I would do is I'd go into the indicator, I'd go to the input section here, and I would change the minimum bars. The minimum bars is the minimum bars between pivots, according to the definition in your manual. So if I change that to 60, representing basically 5 minutes, the results are going to be considerably different. Notice. All right. Now we don't really have anything on the screen at all. And part of the reason for that is we didn't change the minimum pivots. Okay, got to go back in. Forgot to change something. All right, we need to change the maximum pivots back. And I like to use a higher number. You don't want to use a real high number. I think 60 is maybe the maximum that I like to use on a 5-second chart. If you go much beyond 60, the time it'll take to calculate the results is exorbitant. I'm going to just use 30 here. And even with a setting of 30, it takes a little bit of time, even with a good processor. Okay. Now, you notice what happened. We got our pivot up here, and we only found this low and this low. Okay? Now, when it comes to divergence, it's comparing the divergence of the oscillator to where it was at the time of the pivot. It is not comparing the oscillator value at the time of the last signal, because you have one here and then you have one here. It's not comparing this to this. It's comparing this at the time of the pivot to this, not to this. Okay? Now, for that reason, the way this is set up right now, you can't get divergence unless the price falls below where it was here. But you don't get any signals. And if we exceed 60 bars, all right, which would have been easily done over in here. Now it's going to have the freedom to start looking for a new pivot. And it doesn't find it until over here, which means now that we can't get a divergence signal unless the ES drops below that price and is divergent to this price right in here.